Becky, first up, tell us, we've had probably the most activity you've had from people asking you, what's going on? What should I do? What's next? What's the general fear from everyone out there? What are they worried about? What are they asking you?
Yeah, the general fear, I think, usually comes from the unknown. And I think that the analogy that you've given with regard to supply and demand and why the Reserve Bank was forced to actually increase rates, basically what they do, they're controlling the level of household disposable income. So the more they contract your disposable income, the less, as you said, you've got to spend on everyday lifestyle products. So when it comes to interest rate rises, I think the first thing that people have to understand is that anyone who's approached the bank for a loan in the last 5 to 6 years, the assessment rates that banks have actually used have been probably 4 to 5% above whatever the standard variable rate is as well. So the banks have actually factored in interest rate rises. All that households have to do now is take a little bit more responsibility. So in the event that you've got $600 less disposable income per month, what you have to do is work out where you're going to make that up. And as you said with me, probably not down to 2 times, well, maybe 1 for me. Right? And that is just the reality from that perspective. That's what you have to do.
So what you're sort of saying is that the banks, they're confident that we can absorb this because they've either lent to us at much higher rates.
Absolutely.
You know, in 2019, you know, Des, when you first got your mortgage in 2013, 2015, you were probably paying
3.5%,
4%.
Yeah.
You know, now you're paying 2%.
Yeah, and banks aren't, sorry, Jay, banks aren't in, I always say this to clients too, banks are not in the business of going mortgagee in possession, repossessing families' homes and actually selling them. That's not the business that they're actually in. So there's no...
Which is funny because a lot of people think that's all they want to do.
Yeah, absolutely not. It's the last thing they want. It's an absolute headache and a nightmare situation for them as well. Yeah. And that's why they've got, you know, hardship programs as well. If clients get into some sort of financial hardship, most banks have got hardship programs, parental leave. If one of the, you know, if the wife falls pregnant, has to have the child and stay at home, banks are there to support you. And that's what we have to understand as well. I mean, there are reasons why rates go up. And I always use this analogy. Water always finds its own level. So there's a bit of chaos out there at the moment. It's like if you put your hand in a bath and you're stirring it and stirring, eventually your hand gets tired.
Yep.
You have to pull your hand out of the bath. And guess what happens with the bath water? It levels itself out. So there's a lot of...
There's a lot of experience of having 5 kids.
5 kids.
You know what it's like. Yeah. Quite a few baths with them.
Especially when you have to bath 5 of them, one at a time as well. So I think that... I mean, it's just water will find its own level. We'll get to a point where the Reserve Bank has increased rates to a level where they're controlling the CPI. Wages will have to start increasing and everything will level out eventually from that point of view. And I think that people just have to, don't panic. I mean, the amount of frantic phone calls and text messages we were getting last night as well. And it's a case of, it's very, very manageable. Give us a call. We'll explain to you what it means from that point of view. We'll go back to the banks. And I mean, there's a couple of examples just today. I mean, we went back to the banks, got a pricing discount of 0.35%. So the rate actually went down by 0.10. It's actually better off as a result of that. And people have to, clients of ours that are current clients and everyday consumers out there have to become proactive.
So Greg, we've been talking about it for a long, long time.
Yep.
Some people have listened and they got a fixed rate.
Yes.
Some people have listened and they've gone and got a better deal. Some people, you know, Becky's tried to help them and they don't listen. What, you know, what is the general feeling out there on the streets? You know, are people, is that it? Has your phone stopped ringing?
No, absolutely not. And I think what we've got to look at very clearly here, we're not even at 1% interest rates. So we've got to look at this in reality. Yeah, we've got from 0.1 to 0.35. It's way below what any of us have any experienced in that. I also believe, my opinion is that the last year or so we've had these crazy price increases. It's been amazing for everybody. It's artificial. It's been an artificial increase. So yes, interest rates, in my opinion, will level things back. And as Becky was talking about, the hands come out.
You got 5 kids, so you've done many baths as well.
So the bath water, essentially raising of interest rates will just make the water calmer again. So we're going to get a bit of those waves will start leveling out and we'll get back to a realistic place where the market is. So I also believe that with the labor market where it is, and once people start coming back in, which they are, we're going to see a bit of a supply shortage. So we're not going to say, people are, the whole world's going to come to an end, the sky's falling, the property is going to fall. I don't believe that's going to be the case. I think we will see some rectification, and then we'll see some leveling. And as long as you manage your stuff, you're not going out 25 times a week, I think we'll be okay.
25. That's just inflation.
So, and just the other things, James, like as you're saying, a lot of the inflation we're seeing at the moment, and I'm not an economist, but just looking at it, is artificial. We've got wars, we've got things like that. So the increased costs are also artificial. So we've had a lot of, again, artificial stuff happening.
Yeah.
I don't think we're going to, I think we'll see some leveling out, but I don't think the world's coming to an end.
So we're not going to sort of, in your view, I go back to, I think I was still in school, and I remember, walking down the aisles in the local Coles supermarket, and they had those big signs saying inflation busters.
Yeah.
Right. Interest rates were at 16, 17, 18%.
Yes.
That's not what you're seeing coming. You're seeing a much more gradual
I think it's a gradual
pull
thing.
back a little bit rather than a...
It's not like that they've gone, even if they do put it up to 1%, we're still not nearly anywhere near the levels, I've experienced that. I'm a lot older than probably not this guy, but anyway, but we've experienced those very, very high interest rates where it's insane.
Yeah.
So yes, the generation that we're in at the moment have never experienced this. I don't believe it's time to panic. As long as you manage yourself clearly, and yes, we will see some rectification, but I don't see, something, the world coming to an end. No.
Okay. Now, the only man that I know that says, don't worry about it when costs go up, it's all tax deductible.
Yes.
That's the case if you're an investor, but not quite the case if you're an owner occupier. It is going to cost you effectively, to some degree, $2 for every dollar extra you do. It is going to cost you $2 on your own home.
Yeah.
These interest rates.
So let's say if your mortgage payment go up by like say $6,000 a year as a result of the increase of the interest rate, then if you convert it to a pre-tax income, it's something around like $10,000 to $11,000. That means you need to earn $11,000 more each year to facilitate an additional repayment of $6,000 a year. That's for owner occupier.
Okay. So I'll make it simple for everyone. Consolidate means you've only got to save $6,000 on eating out. If you want to continue that lifestyle, you've got to earn double that. Okay. Now, for some of you out there that are in Bitcoin, you'll say, I'll make that much before I even open my eyes and have breakfast. Fine. But for most of you hardworking, ordinary Aussies, just remember that everything for your own home is with after-tax money. And that's why Becky was explaining the banks know that you can afford it. They know that you will cut costs. And if you're cutting costs, you only need to cut the amount that you need to pay extra in your mortgage. If you intend to keep your lifestyle the same and earn more, you'll generally need to earn almost double the amount. Now, I'll come back to that in a minute. The question I heard everyone asking you yesterday as well, in amongst the fear and the worry, was, give me a fixed rate. Should I be taking a fixed rate? Let's do it now. Now, I know that you wanted to say to them, I've been banging on about this for the last 2 years and you wouldn't listen to me. Yes. All of a sudden, you're answering my call, you're texting me.
Absolutely.
It was like my
popularity just skyrocketed overnight.
Yeah. You felt like a rock star.
I did, I did.
So tell us, Des listened to our advice. He got a fixed home loan rate about 1.99%.
He did, yes, yes.
Where are rates sitting at the moment versus variable? And I know you've got a graph here which is probably too small for people to see.
Yeah.
But you've done a bit of analysis that sort of gives everyone an idea as to whether they should be taking out a fixed rate now or maybe the break-even point.
Yeah, and I think that what's happened, I mean, that's very, very easy for me to explain, even if people can't see it. But when it comes to fixed rates, I mean, you have a look at Des a couple of years back. I might pop this here. I know that it's probably not professional with the viewers looking at me, but
come up and walk us through this.
Pop that on there. Yeah, I might do that actually. Yeah.
You've done the hard work.
Can you hear me now, Maxie? Sorry. So let me go back a few steps. When we have a look at 2 years ago, when we actually did Des's loan, I mean, fixed rates were incredibly low at that particular point in time. Banks had the belief, and so did the Reserve Bank, that rates were going to remain low for quite some time. So Des was fortunate that he took out a very, very good and very, very low fixed rate. What's happened over the last couple of months, we've talked that rates are going to increase. The first thing that banks have actually now done is started to increase the fixed rates. What's happened now when it comes to fixed rates, the horse is actually now bolted. And what do I mean by that? If you have a look at, the average 3-year fixed rate might be sitting at, call it 4%. We've used a bit of a scaled example here at 4.79. Why we've done that is because we're going to assume that fixed rates are going to continue to go up a little bit, before people make the decision to lock in. But I had a client last night who was incredibly frantic, that desperately wanted me to somehow magically fix their rate while I was on the phone with them. And I said to her, look, Mary, what you've got to understand is this. By the time, if you fix a rate today at 4%, your variable rate is at 2.19. You need a hell of a lot of increases over the next 3 years to get that variable rate to 4%. But what you're doing, you're talking about, you're panicked because the rates have gone up 25 basis points, but you're about to lock in a rate, or you're forcing yourself to lock in a rate 2% above what the variable rate is. So what you've actually done is forced your repayments up immediately. And it just doesn't make logical sense to actually do that. Because if the spread between the fixed rate and the variable rate was a lot lower, then yes, you may do that. But it's going to take you 3 years for the variable rate with an average of 0.25% increase every quarter to actually catch up to where the fixed rate is at the moment.
Yep. So I guess casinos never lose.
Never, no.
Banks, it would appear, never lose either.
Or just look at their annual profit. I don't think they're not in the business of losing money. Yeah.
So, I guess, when we think about fixing rates versus variable rates, we never normally do what we should be doing at the right time. And I guess what you've done here and sort of looked at it is to say, well, if you want to have some certainty, fix a payment amount today and it never changes, so you can adjust your budget, then great. And if that's what makes sense to you, and that's, part of, remember, the third pillar is managing yourself, your time, your experience. And it might be that you just want the certainty for the next 3 years, that nothing else is going to change, then maybe that's for you. But what you're actually saying is that by the end of the 3 years, you're still behind.
Oh, absolutely, yeah.
You've assumed here that every single quarter we get
0.25% rate increase every single quarter for the next 3 years. That's the assumption that I've made. Yeah. That's pretty aggressive too. That's a 3% increase in rates in the cash rate over the next 3 years without actually knowing. And what's going to happen if all of a sudden supply and demand starts to even out a little bit? Well, guess what? The Reserve Bank will probably slow down because the CPI might be under control by that time, or the inflation rate will be under control. They might slow down rate increases and then let it level out for a period of time.
Okay. So with this in mind, and let's not forget as well, once you fix the rate and you suddenly get that big bonus or whatever, you come into an inheritance or whatever, you can't pay down without having to break that rate.
Well, only $10,000 a year you can pay down without getting hit with penalties. Yeah.
What are you sort of saying to people right today? If they're calling you and stressing about it, obviously we don't know everyone's personal circumstances, but as a general thing, what's the advice out there to people? Should they be rushing and locking in a rate? Should they be doing it for part of their mortgage? Should they just be waiting? Where's
my recommendation is this usually, is that if you want to lock in a rate today, so you have a look at this in the first month. There's a big difference there. It's what is it, $800 a month difference. If you can afford an additional $800 a month and you want to take the stress and the panic out of rate fluctuations, well, I think you'd be silly to go and force yourself. You're talking about another $800 a month you force yourself to pay. Why would you do that? That's exactly right. That's after tax. Why would you force yourself to do that? It's only a 25 basis point increase. What we have to do is wait and see what's the impact of that 25 point increase. Yeah. Is it going to curb inflation at all? Maybe 25 points on it. Maybe 25 points is enough for the next quarter, for argument's sake. You just have to wait for the water to level itself out. Because me personally, the opinion is you should have been having conversations about your fixed rate when we were sending out all the correspondence.
So all those phone calls, text messages, emails that went unanswered?
Well, I had to keep checking my phone to make sure someone had paid my phone bill because I thought, well, my phone's not ringing. So,
as we were preaching
a
couple of years ago, fix your mortgage when it was at under sub 2%.
Because I don't want our staff members to be fixing their rates, because the only way that they're going to counteract that is going to come and see you for pay rises.
And what happens there? CPI keeps going up again.
You bet. Don't give me a reason to convince myself we can't afford to keep you on as a staff member anymore.
Okay.
Just kidding, guys.
Now, I was just having a quick look as Becky was going through that. I've got a ton of questions here, but just conscious of time. what we'll try to do, if we haven't answered your questions, we've got a record here. We'll come back to you individually. So if you've got any others, drop them in the comments, drop them in the Q&A, wherever it is, and we'll make sure that we come back to you. And if you want us to give you a call to discuss in more detail, put your contact details in there, and we will do that. But before I wrap up, guys, where's the sort of prediction? What are we expecting is going to be the peak of when rates sort of, level out and they don't keep going up, and where you're sort of seeing the Reserve Bank is going to find that new normal? Greg, you want to start first?
I don't know.
Okay.
But
good.
I'm not in that sort of thing, but I think as Becky was suggesting, is that it's probably going to be a steady thing. Try and get a bit of normality back in the market. As I say, from my perspective, everything that's happening has been it's falsely pushing things to a point where it shouldn't be. So I think that they will do step by step by step. That's what I think. I don't think we're going to hit the major stuff that in the 80s we saw. I don't believe that at all.
Okay.
Yeah.
Des, what's your view?
I think you correctly pointed it out at the beginning. Once
Pay rise for you. Thank you.
Done. In my mind, once my country reopened and when the war is over, I can see things is going to start slowly normalized. That might be the time we can think, oh, when is it going to stop increasing the rate, or everything's back to normal? For now, I don't know.
Okay, so we've got so far 2 I don't knows. Hopefully that's helped you. Becky, you're gonna round it out and give us a hat trick if I don't know, and leave it all up to me to make the forecast and prediction.
I probably might leave the forecast and prediction too then, James. You just gave me a bailout. If you didn't make that last comment, then I was about to do it. But
well, I figured I might as well get a hat trick. At least I can have something.
Yeah. Well, look, I actually don't know. What I do know is we know that there was a rate increase that went through yesterday, and all you can do is, accommodate for your circumstances based on what we do know. Become proactive. And when I say proactive, extremely proactive. Now's the time to be really alert and making good, conscious financial decisions. And yeah, give us a call and we'll help you out.
All right, so they've left it up to me. The Reserve Bank yesterday said they see the new normal between 1.5 to 1.75%. But guess what? They lied to us last year. They lied to us last month. Or they didn't lie to us, but they've actually had to accept that they've got very little credibility in forecasting because there are so many factors. Now, don't get me wrong. It's really, really hard. I'm taking a swipe at them because it's fun. And it's fun to blame someone else when we can. But, who would have predicted the war in Ukraine? Who would have predicted that while the rest of the world has opened up and forgotten about coronavirus, that China started there, invented the concept of a lockdown, has gone back into lockdown? You can't predict these things. So I will make a prediction. I will sort of lay it out there for you. I think the new normal is going to be somewhere between that 1.75 to 2%. And I think we're probably going to get there and stop seeing these increase in rates somewhere in 2024. I don't think it's going to have a huge impact on house prices. I think there's going to be certain areas that will be impacted, that perhaps people were overpaying in the first place. But I really don't see a big thing because, what we are seeing, whilst we've mentioned a lot of the supply side factors are driving this, on the demand side, because of the borders being locked, because of no migration, because we don't have the backpackers, we don't have the students, definitely at the lower end jobs and more of the entry level jobs, the hospitality jobs, there is no staff out there. We know it in our business, we're struggling to fill those jobs. So there are increase in wages. We're paying more for staff now and they're not better staff. It's just a factor of the market. So generally people do have a bit more income. They can sustain this. And I don't think we're going to see a major shock. If you haven't brought a home yet, what does that mean for you? Well, the right time to buy when you can afford it. So if you can afford it, you should still be buying. Don't wait. Don't try and pick the market because as Greg has remembered, what we always say, it's not timing the market, it's time in the market.
Yeah.
All right. Anything else you guys want to add before I wrap up?